Did you know that the stock market experiences an average of one correction? That's a drop of 10% or more every year? It's true. It's like the financial equivalent of your least favorite aunt showing up unannounced. You know it's going to happen eventually, but it still manages to throw your plans into disarray. But here's the thing. While we can't control when the market decides to take a nosedive, we can absolutely control how we react to it. We can either panic and make rash decisions, like selling all of our investments and hiding our money under the mattress, or we can be smart, stay calm, and weather the storm. That's what this video is all about, giving you the tools and strategies you need to protect your hard-earned money when the market goes haywire. So buckle up, because we're about to delve into the wonderful world of market dips and how to survive them, maybe even thrive a little. All right, let's start with the absolute bedrock of financial stability. The one thing you should have in place before you even think about investing: an emergency fund. Think of it as the financial equivalent of wearing clean underwear. You hope you never have to show it to anyone, but you're awfully glad you have it when you need it. Now, an emergency fund is not your "I really want that new pair of shoes" fund. It's your "oh God, the car broke down and the dog needs surgery" fund. It's there to cover those unexpected expenses that life throws at you, without forcing you to dip into your investments or, God forbid, rack up credit card debt. How much should you have in your emergency fund? Well, the general rule of thumb is 3 to 6 months worth of living expenses. But trust me, having that financial cushion will give you peace of mind and prevent you from making rash decisions when the market takes a tumble. You won't be forced to sell your investments at a loss because you've got your trusty emergency fund to see you through. So, do yourself a favor and prioritize building that emergency fund. Now let's talk about your investment portfolio, which, for the love of all that is financially responsible, should not be crammed into a single stock, no matter how much you believe in that company's ability to take over the world. Remember Enron? Yeah, nobody wants to be that guy. This is where diversification comes in. Instead of putting all your money into one stock or even one asset class, you spread it around, investing in a variety of different assets like stocks, bonds, real estate, and maybe even a sprinkle of that cryptocurrency everyone's talking about. The beauty of diversification is that it helps to mitigate risk. When one asset class is down, another might be up, which helps to cushion the blow to your overall portfolio. Think of it like this. If you only invest in umbrella companies, your portfolio is going to be soaked when the sun comes out. But if you diversify and invest in sunscreen companies too, well, you're golden. Now, I'm not saying that diversification will completely shield you from market dips. It won't, but it will make those dips a lot less bumpy. Okay, so you've got your emergency fund in place and you've diversified your investment portfolio like a pro. But even superheroes need to make adjustments to their suits every now and then. That's where rebalancing comes in. It's the process of periodically reviewing your investment portfolio and making adjustments to ensure that it still aligns with your original investment strategy and risk tolerance. Think of it like going to the mechanic for a tune-up. It's not the most exciting thing in the world, but it's essential for keeping your engine running smoothly. You see, as markets fluctuate, so too will the value of your investments. Some assets might outperform others, causing your portfolio to become overweighted in certain areas and underweighted in others. This can throw off your original asset allocation and potentially expose you to more risk than you're comfortable with. Rebalancing involves selling some of your high-performing assets and using the proceeds to buy more of your underperforming assets, bringing your portfolio back into alignment with your original target allocation. It's a bit like pruning a tree. You're cutting back the overgrown branches to help the tree grow stronger and healthier in the long run. Now let's talk about a specific type of investment that can be particularly helpful during market downturns: defensive stocks. These are stocks of companies that tend to hold up relatively well during economic recessions because they provide essential goods and services that people continue to need, even when times are tough. Think of it this way. When the economy goes south and people are tightening their belts, they might cut back on luxury items like vacations and fancy dinners. But they're still going to buy groceries, pay their utility bills, and take their medications. That's where defensive stocks come in. Companies in sectors like consumer staples, think food, beverages, and household products, are often considered to be defensive stocks. Healthcare, think pharmaceuticals and medical devices, are also included. And utilities, think electricity, gas, and water, are often considered defensive stocks as well. These companies tend to have stable earnings and pay consistent dividends, which can provide a welcome cushion for your portfolio during market volatility. Now, it's important to note that defensive stocks are not immune to market downturns. They might still decline in value, but they typically decline less than the overall market. Investing in defensive stocks is about protecting your wealth and providing a degree of stability to your portfolio during turbulent times. Look, I get it. Navigating the world of finance can feel a bit like trying to assemble IKEA furniture without the instructions. Confusing, frustrating, and likely to result in a few leftover screws and a wobbly bookshelf. You might be tempted to just throw your hands up in the air and say, "To hell with it, I'll just live in a cardboard box." But before you embrace a life of minimalist living, consider this. You don't have to go it alone. Just like you wouldn't perform surgery on yourself, you don't have to manage your finances without professional guidance. That's where a financial advisor can be worth their weight in gold, or in diversified investment portfolios. A good financial advisor is like a financial therapist, a personal trainer, and a life coach all rolled into one. They'll take the time to understand your financial goals, risk tolerance, and life circumstances, and then they'll work with you to develop a personalized financial plan to help you achieve those goals. They can also provide valuable insights and advice during market downturns, helping you to stay calm, make informed decisions, and avoid making rash moves that you might regret later. It's all about finding an advisor who's a good fit for you and your financial situation. All right, let's say you've got your emergency fund, you've diversified your portfolio, you're rebalancing like a boss, and you've even got a financial advisor on speed dial. But there's always room for a little more diversification, right? That's where alternative investments come in. These are investments that fall outside the traditional asset classes of stocks, bonds, and cash. We're talking about things like real estate, commodities, think gold, oil and coffee, private equity, and even fine art and collectibles. Now, alternative investments can be a bit more complex and illiquid than traditional investments, and they often come with higher minimum investment requirements. But they can also provide diversification benefits and a hedge against inflation, which can be particularly valuable during times of economic uncertainty. Think of it this way. When the stock market is tanking and the value of your dollar is shrinking faster than your patience for politicians, having some of your assets invested in tangible assets like real estate or gold can provide a sense of security. Of course, as with any investment, it's important to do your research and understand the risks involved before diving into the world of alternative investments. But if you're looking for ways to further diversify your portfolio and potentially enhance your returns, alternative investments might be worth exploring. We've covered a lot of ground in this video, from emergency funds to defensive stocks to alternative investments. You're practically swimming in financial knowledge at this point. But here's the thing about knowledge. It's like a plant. You need to keep watering it if you want it to grow. In other words, staying informed about market trends and economic developments is crucial for making sound financial decisions and protecting your wealth. You don't need to become a Wall Street whiz kid or spend all day glued to CNBC, but you should make an effort to stay up to date on the factors that could impact your investments. Think of it like checking the weather forecast before you leave the house. You wouldn't go out in a blizzard without a coat, would you? Similarly, you shouldn't make investment decisions without having a basic understanding of the economic climate. The key is to find sources that you trust and that provide accurate, unbiased information. By staying informed, you'll be better equipped to navigate the ups and downs of the market and make smart decisions that will help you achieve your financial goals. So there you have it, folks. We've covered a lot of ground, but the key takeaway is this. Market dips are a normal part of the investing cycle. They're not a reason to panic. They're an opportunity to adjust your strategy, stay the course, and even potentially come out ahead. Remember, building a solid financial foundation takes time, effort, and a healthy dose of common sense. It's not about getting rich quick, it's about making smart choices that will help you achieve your long-term financial goals. Now, I want to hear from you. What are your go-to strategies for protecting your wealth during market downturns? Share your tips and tricks in the comments below. Until then, stay informed, stay invested, and stay fabulous.